Good to go? Good evening, everyone. Thank you for joining us today at HCLTech's first quarter of FY24 earnings announcement. I will directly get into the business performance for the quarter. Q1 is typically a soft quarter for HCLTech due to the fact that productivity benefits for a large number of contracts kick in during the quarter. Having said that, though we did expect this to be a soft quarter, our performance was lower than our own expectations. I'll explain the factors influencing this in just a bit. Our revenues declined 1.3% sequentially, and our revenues grew 6.3% on a year-on-year basis in constant currency terms. In terms of our performance, in terms of an operating parameters, our EBIT came in at 17%. This is at the same level as our Q1 last year, which was also at 17%. On a sequential basis, it has declined from 18.1% to 17% this quarter. In terms of bookings, as you're all aware, our bookings for the previous 7 quarters have been in the range of $2 billion and above. This quarter, our booking was at $1.6 billion. It's been a little softer. However, I'm very happy to report that our pipeline continues to grow. Last quarter, we did report that our pipeline has grown significantly. It has further grown in a strong way, even in this quarter. And we are very optimistic about the pipeline conversion and its revenue translation that will help us meet the full year guidance which we have given. Our headcount also declined last quarter by about 2,500 people, primarily due to the fact that we've consciously not backfilled some of our attrition. Double-clicking on our quarterly performance by service line, our IT and business services had a good momentum on the new deals signed. A lot of new deals signed ramped up quite smartly, but most of the gains were offset with the reduction in discretionary spend in a couple of verticals. This has resulted in our ITBS segment being flat in constant currency terms. Our ERS business continues to be soft, primarily driven by tech and telecom verticals. Our ERS business reported a decline of 5.2% quarter on quarter in constant currency. HCL Software continues to demonstrate a lot of resilience. On a year-on-year basis, the revenues in HCL Software has remained stable. In terms of verticals, 3 of our largest verticals delivered very strong double-digit YOY growth. Like financial services grew 5.1% sequentially and 14.4% year-on-year in constant currency. Manufacturing grew 3.6% quarter on quarter and 16.5% on a year-on-year basis. Life sciences and healthcare vertical also demonstrated strong growth of 13.4% year-on-year. These 3 verticals contributes to more than 60% of our total revenue. And growth in these verticals is really a great execution of large deals, which is translated into revenue. This has helped offset some of the reduction in the discretionary spend, and the net impact, we've delivered strong growth in these three verticals. On similar lines, we saw decline in tech and telecom verticals, primarily driven by a reduction in discretionary spend and the associated ramp downs. We are expecting these two verticals to pick up as well shortly. Coming to the geographies, on a YOY basis, Europe grew 10.5% in constant currency. Americas grew 7.3% in constant currency, and rest of the world declined by 6% in constant currency. We continue to focus on bringing more and more innovation to our clients. I want to give you a quick update on our Gen AI initiatives. Our approach has been driven by our engineering and innovation spirit. Given a powerful tool as Gen AI, all our efforts are geared towards harnessing the power to bring exponential innovation into all of our services, solutions, and the products. Our Gen AI labs, we have built and launched Gen AI labs in 3 locations across the world. These are the anchors and incubators to the solutions we are developing and have developed around digital workplace services, engineering services, digital business services, digital process operations, and HCL software products. Currently, we have 140 plus external and internal projects at various stages of maturity, from proof of concepts to implementation. We've seen some good success in a couple of client-facing programs on Gen AI in the healthcare side, and we are also seeing some benefits. Though it's early days, we're seeing some good benefits of how it can be leveraged in IT operations. With that, I would want to also just summarize it by saying on an overall year perspective, given the strength of our pipeline and the momentum that we have in a few verticals and the momentum we expect to have in the rest of the verticals, we continue to maintain our guidance of 6 to 8% growth in constant currency for the full year, and we continue to maintain our EBIT guidance of 18 to 19% for the full year. With that, I will request Prateek to share more financial details.
Thank you, CVK. So I'll just give you some color on the rupee numbers as well. So the company, HCLTech company revenue in rupee terms was at 26,296 crores, which is a 12.1% growth year on year. And services within that grew faster at 12.9% year on year in rupee terms. As already covered by CVK, in constant currency terms, our growth was 6.3% at a company level. Services grew at 7.1% in constant currency, and software was flat year on year. Our EBITDA margin for the quarter is at 20.5% and EBIT at 17% of revenue, and net income at 13.4% of revenue, which is up 7.6% on a year-on-year basis. Our focus on ROIC as a metric, return on invested capital, continues to move the needle. LTM, last 12 months, ROIC as of end June stands at 31.1%, which is an increase of 2.6% or 260 BPS on a year-on-year basis. Also, our cash generation or cash conversion ratios continue to be very robust. Our operating cash flow came in at 3,970 crores for the last 12 months, and free cash flow FCF at 3,688 crores, which are respectively 135% of net income and 126% of net income, both very, very healthy ratios. And our balance sheet continues to remain strong with gross cash at $2.66 billion and net cash at $2.4 billion. From a shareholder's perspective, the last 12 months diluted earnings per share is at 55 rupees 70 paise, which is 11.3% growth on a year-on-year basis. And the board has declared a dividend of rupees 10 for the quarter in line with the previous practice. The record date for which is 20th July, and the payment date shall be 1st of August. And the payout ratio on a last 12-month basis is 86% of our net income, which is aligned with our capital payout policy of minimum 75%. With that, I'll hand over to Ram, our CHRO.
Thank you, Prateek. Good evening. We ended the quarter with the people strength of 223,438. We saw a reduction of 2,506. That's about 1.1% quarter on quarter. That's in line with what you saw with our revenue performance. Attrition continues to be a positive story. The LTM attrition for IT services is 16.3%. That's a 320 BPS drop from previous quarter. And on a year-on-year basis, that's a 750 BPS drop. So attrition continues to be a strong story. One update, typically this time of the year, we make our announcements on pay reviews. Last couple of years, the hiring that we have done and the compensations that revisions that we have done in the last couple of years, so we've taken that into consideration and have taken a decision to defer our annual reviews by a quarter. So that's one update. With that, I'll hand it back to CVK. Want to open for questions?
Yeah, sure. We can take questions from the room, and then we can take questions on the call.
That's question.
Hello. Yeah. Hi, this is Ayanti from Informist Media. Just wanted to start by asking, on the profit side, it's a bit worse than expected by analysts. Where did you exactly see the demand challenges, in which verticals and geographies, if you can give me some color on that?
Yeah, as it is visible in our published numbers, our growth in tech and services and telecom and media and publishing, these two verticals are the two verticals where there is a decline. And that's also to some extent reduced our utilization, which shows up in the profitability metrics.
Just one more from me. Yeah. So you have maintained your guidance for FY24, both in EBIT and revenue. Given the macro conditions right now, do you expect to continue it for the rest of the year? And is there a possibility of a downward revision?
No, I think we take a call based on what we see. So at this point, we believe we have enough momentum in terms of pipeline and the verticals which have done well. So we have maintained the guidance. So you cannot comment on what is the future. I mean, every quarter we will review it and provide you an update. At this point, given all the data that we have, while this quarter the booking has been soft, we believe we will more than make up for the shortfall in the coming quarter. So we feel quite confident of that. And that will drive the revenue momentum.
Hi, I'm Abhimanyu from CNBC TV 18. I have two questions. Firstly, are you seeing any projects getting paused or cancelled in near future? And secondly, are there any verticals where you're witnessing stress? And if at all, there is any corrective strategy in the offing?
Yes, I wouldn't say any project is entirely cancelled, but there has been sporadic crampdowns. Given we have a strong presence in tech, it's almost 14% of our revenue in the past quarter. So we've seen some ramp downs in the tech segment. We've also seen ramp downs in the telecom segment, which is also visible in our numbers. So these are the two where we see some stress. But again, it's a cycle, right? We saw decline in discretionary spend in some verticals like manufacturing and financial services, and that has got more than offset by the efficiency-led deals that we won in the past quarters. So you see a very smart growth in financial services. We grew 5.1% and year-on-year 14.4%. Similarly, 16.5% in manufacturing and 3.6% sequentially. So that is really the cycle change, where the discretionary spend is going down and it has got filled with new projects, new wins, which is contributing to the growth. So in telecom and tech, we are still maybe a quarter behind, I think, to kind of offset these two dynamics that are playing out. And we're pretty confident that we will deliver decent growth in these verticals, which will also help us deliver the full year guidance.
My second question was whether there are any verticals where you're witnessing and any corrective strategy as such?
No, I think a lot of it is very, very dependent on the client situations. Some customers are focused on how can they get the same outcome in their new projects at a lower cost. So we have specific strategies to accomplish that. And there are customers who want to bring more efficiency to kind of offset some of the inflationary trends that they're seeing in their business, especially the telecom segment. So we are working with them to find out more cost reduction kind of programs. So it's very client specific at this point in time.
No more questions from here.
Hi, this is Praveen Sharma from Bistak. Actually, I have a question for you. Your margin for quarter one of this fiscal is fell down to below 16%, and
no, it's at 17%.
yeah, nearly 17%. So, what was the reason behind?
So basically, if you see last year Q1, our margins were again at 17%. So usually Q1 is a seasonally soft quarter. So this is the quarter in which productivity benefits are extended to customers, and the revenue growth revenue has declined, which means we have a little bit more utilization possible, which is really hitting the cost, and that's why the margins
I
are
have
low.
one more question. How do you see next 9 to 12 months in terms of revenues, and what are the key challenges?
Yeah, I mean, this is something we have been talking about in the past as well. I think there is macroeconomic aspects do play into clients' mindset. Whether a recession is happening or not, it is the fear of recession which is driving some behaviors. And I think it is getting stabilized. I mean, you can see that in 3 of our verticals, we've seen a stability and even growth, and a couple of other verticals will follow the course. So I do remain very positive because our pipeline is at an all-time high by a big margin. Last quarter, I said it had gone up significantly, and this has gone up further now. And the pipeline, which is in an advanced stage, is also quite large. So all of that, we expect to see very strong bookings in the coming quarters, which will augur well for this year and potentially next year.
So we can move to the people who are joining us remotely. Siddharth, over to you. Can you please take the questions?
Sure. Thank you, Ashutosh. Our first question today is from the line of Sai Ishwar from Economic Times. Sai, please go ahead. Sai, please go ahead. We have unmuted your line.
Yeah. Gentlemen, can you hear me?
Yes.
Yeah. So, first of all, I just wanted to know what the numbers. Actually, it's down usually like for the last 2 quarters, and YOY basis, it's around $2 billion. But now this quarter, you've just given $1.5 billion. So I just wanted to know what is the primary reason which is driving this. And also, I also wanted to know that profit is down on a sequential basis. So what contributed to this fall, despite you said that annual compensation has been put on hold. I just wanted to know that. And also, I wanted to know, you said that some of the attrition backfilling, you are consciously not done it. Why is that the reason? Thank you.
Yeah. So maybe I'll take the booking question, then Pratik can respond on the margins, and the people question, Ram will respond. In terms of bookings, we had like 7 sequential quarters of 2 billion plus booking. And booking by nature is it can be spiky, it can be lumpy. It is just a coincidence that we had a very, very stable booking for last 7 quarters. It's quite possible one quarter you may not have the same level of large deals or same level of small deals. So that's why it's 1.5 billion, 1.6 billion this quarter. And I think what's important is to see all of this on an annualized basis. And maybe if you take the pipeline and the expected conversions, we feel pretty confident. This is just a blip, and we will more than recover in the booking numbers in the coming quarters. Pratik, you want to?
Yeah. As far as the margins are concerned, we are at the same point as Q1 of last year. So if that is any consolation, that's the same starting point. And we have definitely put together in the last few days since we started looking at the numbers ourselves, action plan which leads to us achieving the margin guidance. So part of that is what Ram already shared with you, and we do have an action plan to reach there. So that is the reason we are maintaining it. I'll leave it there for the time being. Ram, for the HR question, please.
So I think the question was about the attrition backfill. So 2 specific things. One, if you look at our current quarter attrition, 16.3, we are effectively back to FY20 levels, which is pre-COVID levels. As I said, that's a 320 BPS QOQ and a 750 BPS YOY. Last couple of years, if you look at the number of freshers that we had added, and last year was a record year for us. So last 2 years, we've been making those investments to add freshers. They go through a cycle of training before they get productive. So that's also flowing through into our productive capacity now. So that's one of the reasons why we didn't opt to go for replacement hires this quarter.
Siddharth, you can take the next question, please.
Yeah. Sure. Our next question is from the line of Ayushman. Ayushman from Business Standard. Please go ahead.
CVK, Ram. So I would like to ask you about the large deals. I mean, according to you, what is the sense in terms of large deals? Can we say that large deals are back? If yes, in which category of large deals are you really seeing? Are these really the cost optimization deals, or are they the real transformational deals?
So large deals, we have several large deals in our pipeline, and that's why we also see our pipeline to be significantly larger than what it was last quarter and what was there last 6 months back. And pipeline has got a mix. Today, cost transformation deals are not just about offshoring and things like that. They are driven by transformation projects which drive efficiencies and reduction in cost. It's about implementing automation. It is about right-sizing some of the technology architecture, modernizing your technology architecture, cloud adoption where it is relevant. So all of this form part of this cost efficiency-led deals. So you should take it like it's a mix of both, but more of the subset of these two, pure transformation and cost optimization. There are deals which have a combination of these two, is where we are seeing more traction.
And to your direct question, yes, the large deals are back.
Yeah.
It may not show in this quarter's number per se, but they are back, yes.
Thank you. Our next question is from the line of Mini Tejasvi from The Hindu. Mini, please go ahead. Mini, can you hear us? I think there's some technical problem in his line. We'll take the next question. The next question is from the line of Debangana from Money Control.
Hello, gentlemen. Am I audible?
Yes.
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 Go ahead.
Yeah.
Yes.
So my question was, so there has been a lot of big misses this quarter, but the guidance remains unchanged. So do you expect the growth to be more back-ended, and does the second half will hold some good recovery for the company? That's one question. And the second one I wanted to understand was, are you seeing clients asking for pricing discounts on deals?
Yeah. So if you look at our the seasonality in our business, Q1 is usually a soft quarter. Yes, we came below our expectations in Q1, but you should see growth improving from here on as we get into the Q2, Q3, and Q4. And that's really based on the pipeline and the advanced stage of pipeline. We feel confident of better growth in the coming quarters. So we continue to maintain our guidance. In terms of pricing reductions, yes, there has been some sporadic requirements from different clients, but it's still, I would say, largely the pricing environment remains stable.
That's it. We have no more questions.
Okay.
For today. Over to you, Ashutosh.
Okay, so I think we're
Yes.
through.
Thank you, everyone, for joining us, and look forward to talking to you during the next quarter. Thank you.
Thank you.
Thank you.